Hello, esteemed listeners and subscribers. Today, we're diving into a pivotal topic that has captivated financiers and economists worldwide: the potential interest rate cuts by the U.S. Federal Reserve. How will this move impact the American economy? What consequences await the global financial system? And what does the future hold for us? I'll be analyzing the current situation, sharing my forecasts, and explaining why this Fed decision could become one of the most significant events of the year. Prepare for a deep dive into the world of macroeconomics. My thoughts on the interest rate in America and its future. As you may recall, we've touched upon this topic before, but I'm ready to delve deeper and share more detailed reflections, considering the latest trends and signals. The current situation and the sword of Damocles of inflation. The Fed finds itself in a very delicate situation. On one hand, inflation, though declining, still remains above the target of 2%. This is the sword of Damocles hanging over the regulator's head. If the Fed starts cutting rates too early or too aggressively, there is a risk of a renewed surge in inflation, which would nullify all previous efforts. On the other hand, there are concerns about a potential slowdown in economic growth. While the American economy has shown remarkable resilience, high interest rates inevitably exert pressure on consumption, investment, and the labor market. Moreover, there's a global context. Slowdowns in Europe and China could also affect the U.S. Key factors influencing the Fed's decision. Inflation data. This will be the main guide. The Fed is looking for a sustained decline in inflation towards its target level. They want to be sure that these are not just temporary fluctuations, but a steady trend. Labor market. A strong labor market gives the Fed more room to maneuver. If unemployment starts to rise noticeably, it will be a strong signal for the need to cut rates. So far, the labor market remains quite robust. Consumer activity. Consumer spending accounts for a significant portion of U.S. GDP. Any serious signs of weakening consumer demand will be closely monitored. Global economic conditions. A weakening global economy could exert deflationary pressure and impact U.S. exports, which the Fed will also consider. Future forecasts. First cut, a matter of when, not if. I remain confident that the Fed will cut rates. The question is when and by how much. Most analysts, and I agree with them, expect the first cut sometime in the middle or second half of this year if inflation continues to move in the right direction. Slow and cautious easing cycle. I do not expect a rapid and aggressive rate-cutting cycle, as has sometimes happened in the past. The Fed will act very cautiously, taking small steps, likely 25 basis points, and assessing the market and economic reaction after each cut. This is a stop and assess approach. Target rate level. What will be the final neutral rate level? This is a complex question. It will likely be higher than what we became accustomed to during the decade after the global financial crisis. The world has changed, and higher inflation, geopolitical risks, and rising debt could sustain higher rates in the long term. Risks. The main risk is the wrong decision. Cutting too early could lead to a new wave of inflation. Cutting too late could lead to a recession. The Fed is caught between Scylla and Charybdis, and the slightest misstep could have serious consequences. Market volatility. Markets will remain volatile, reacting to every Fed statement, every inflation report, and every labor market report. This is an ideal time for speculators and a test for long-term investors. Conclusion. The future of the U.S. interest rate is not just a technical decision, but a complex dance between data, expectations, and the global environment. The Fed will be forced to balance the risk of inflation with the risk of economic slowdown. My forecast is for a cautious and gradual reduction in rates, likely beginning in the second half of this year if inflation is under control, and continuing with pauses to assess its effect on the economy. The world continues to be in watchful waiting mode regarding the Fed's actions, and each of their meetings will be subject to close analysis.